Hi there, Serial Trader here. So checking with the major US indices and start off with a chart of SPX here. Now, since the last video on Monday, we've still been trending down, and this T line has been acting as resistance. So currently, I still like that we just have this ABC up for our corrective wave up, and that's it for possibly wave 2. And now we're just heading down in our third wave, and that'll be that. And we make a new low soon. Now that's the simplest and currently, looks to be probable scenario in play. But I will just, go over the alternative that could still be happening. And again, we could still be developing a more complex correction upwards in a, W, X, Y, for instance. And let me just bump the degree up a bit on that one to minor. So it could just be ABC up for W, in which case the ABC up would have to be dropped down to that degree, as it would just be the subdivision of W. And then we're coming down in wave X, make a higher low, and then go up in wave Y. Now I obviously don't currently favor this because there's no reason to. So far we've just been trending down as this most basic wave count would implicate that we should, and it's still working. So no need to change the count at this point, but just be aware that this could still play out more complexly to correct more time, as discussed before. And we'll just have to see if we can actually come down and take out the lows or not. So far we've filled both the gaps at this point, or just about filled this lower gap. Let's see if it actually filled. High of that bar was 26.85.43. The low of this bar was 26.85.75. So didn't quite fill the gap by less than one SPX point, but basically filled it. And then had some reaction off of there. And actually, just not so surprisingly, perhaps, we had a reaction off not only that gap test or gap fill there, but basically right off the 618 retracement, or just shy of it by a point or so as well. So that's pretty commonplace to at least temporarily bounce off of. But we'll see if that actually holds up, and I suspect it won't. And we'll get to the candlestick chart in a moment to go through why that doesn't look like it'll hold. And I'll just get rid of this WXY for now, because so far this is working, so we'll go with it. And yeah, I mean, just I'll mention one more thing. Some people are bringing up that we have possibly an inverse head and shoulders bottom forming here, and we'll be reversing to the upside, and that would mean that you had the left shoulder here, this is the head, this is the right shoulder, and then we'll come up and reverse upwards. That's possible, but I don't think it's very likely, just going by the Elliott wave pattern I'm seeing, and the negative candlestick patterns that we'll get to that I'm seeing. I view this inverse head and shoulders as kind of grasping at bullish straws at this point, but good to be aware of, and really to just solidify that we're just going to go down. We have to take out the lows here at 26.0354. That'll be true confirmation that we're just coming down right away. Up until then, there is still room for doubt and an alternate wave count, and the potential of this inverse head and shoulders forming. Although the lower this supposed right shoulder goes, the less and less in play that is as well. So just keep that in mind. Now, just to be the devil's advocate, if I was just to ignore this whole decline that we had, and the fact that it counts nicely as 5 waves and broke multiple support levels and all that, if I just ignore that completely and say, hey, we're just starting a new trend right here, we got 1, 2, 3, 4, 5 up for 1. By the way, this is a very poor way of counting 5 up. In fact, on my other count, we actually have an ABC up, 5, 3, 5. But let's just pretend I'm forcing it. 1, 2, 3, 4, 5 up for 1. ABC down for 2. Oh, look, we just pivoted off the 618 retracement. Just fill the gap. And now we're just ready to go off to the races in a third wave up. Not the likely scenario, but I just put it here as an alternate. What if it happens? If it happens, then you have to accept that this is the way it's playing out. But definitely not favoring this one. But just thought I'd throw it up there. Okay, so this is definitely the currently preferred outlook. Seems the most probable still. And okay, I think that's probably good for the wave chart. We'll go to the thinkorswim candlestick chart now. Now, why do I prefer further downside as being the most likely here? Well, looking at the candlestick chart here. Okay, so we've lost the 200-day moving average. That's not particularly bullish. We're basically using the T line as resistance on every little bounce up we have. You see we resist against the T line and keep closing well below it. And the 3T line has crossed below the T line, so we got that nice bear cross in play. Our daily oscillator, the stochastic oscillator, is nowhere near oversold. So that just allows for further room before it gets to that condition, further room to the downside. We filled both these gaps now, so they're no longer breakaway gaps. And at this point, today we did a nice daily bearish engulfing candlestick, engulfing yesterday's candle, the real body. So that's a legitimate candlestick sell signal, a close well below the T line. And of course, the engulfing pattern implies the next 3 to 5 candles will trend in that direction. So the next 3 to 5 days, in this case, is the implication. And, you know, we're really not so far away from the lows at this point. So today's intraday low was 2685.75. The low we have to go down to is just above 2600. So a couple bad days, 3 or 4 bad days, or maybe even one really bad day, and we're right there. So if we get some follow through from this bearish engulfing, it's not hard to see these lows getting taken out, and then of course expecting some pretty significant bearish follow through. All right, well, that's probably good for SPX here for now. And let's go to the Dow Jones Industrial Average. Okay, and on the Dow, similar outlook. The Dow did a nice bearish engulfing candlestick, closed just below the 200-day simple moving average, so the Dow has now lost the 200, basically sitting on it, but closed slightly below it nonetheless. And the Dow didn't quite close its gap, pretty close today intraday, but didn't quite close it. The oscillator nowhere near oversold, still coming down, so certainly still room there for further downside before that would be in the oversold condition. So yeah, the Dow 3T line crossed below the T line, so very much in the same technical condition as SPX. All right, move on to the NASDAQ composite, and let's have a look here. NASDAQ composite, nice bearish engulfing daily candlestick. Close well below the T line. Again, using the T line as resistance on these little bounce attempts up. So rejecting the T line, which is in a downward trend itself, as resistance. 3T line crossed well below the T line, trending down. In fact, we're closing well below the 3T line. Oscillator nowhere near oversold yet, so still room for further selling. And actually, the NASDAQ more than closed the gap, its equivalent gap. And it's the closest to testing its lows. So it's definitely the weakest, showing bearish leadership. So today's intraday low, NASDAQ 7101.17. To actually take out the October 29th low, that brings us 69.2283. So really not so far away. The NASDAQ's the closest to getting there so far. And yeah, NASDAQ definitely looks to be the bear leader. All three indexes have done this bearish engulfing candlestick today, rejected off the T line. So it's looking weak. The path of least resistance still seems to be to the downside, and it will really clear things up from a trading perspective by actually taking out this low at that point, you know, we're going to look for those downward targets that I mentioned in the last video. Up until then, we can still entertain some doubt that we're going to hit the low right away, and that maybe we make a higher low and then do another leg up for a more complex upward correction. But still currently favoring just doing it right away, thanks to, you know, the candlestick signals along with the Elliott wave interpretation. Okay, that's the NASDAQ composite. Here's the VIX. And the VIX is coming back to life, so that's also bearish for stocks. And you can see the VIX, after finding support right on its 200-day simple moving average and having its golden cross, the 50 crossing above the 200. VIX intraday today went as high as 22.36 and closed at 21.25. So it looks like the VIX uptrend is resuming, which you know, implies the downtrend in equities is also resuming. Okay, that's good for the VIX. And just from a trading perspective, still have the back spread on, haven't made any changes. As long as things continue to be working and it appears that we're on track, I'm just going to leave that position in place. So if and when I do take some follow-up action, I'll certainly update it in these videos. But for now, just staying with my conviction for further downside until given a reason not to. Now, what would be a reason not to? We'll end the video soon, but I'll just highlight that not only is a engulfing candlestick a good signal, whether it's a buy or a sell signal, in this case a sell signal, it also gives you kind of a level to define, you know, a trade against, or to define risk against. So at this point, you wouldn't want the bearish engulfing candlestick to have its high violated by any kind of upward retracement. So we can define where we would make some changes, or reconsider the trade, or reconsider our outlook for that matter, by the high of today's candlestick, which on SPX is at 2746.8, which also happens to be above the T line at this point. So if it takes that out, then this is a failed bearish engulfing candlestick, and a failed engulfing candlestick is actually a good signal in the other direction. So a failed bearish engulfing would actually be a fairly decent buy signal, okay? So that is significant if we took out 2746.8, which is roughly around 2750, but that's the exact level. And that would definitely get us above the T line, which we've been, you know, resisting against in this downtrend. And on the hourly chart, I just want to point out, so hourly, we just been in a nice downtrend, lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, another lower high intraday today, and, you know, expecting more lower lows. But to break the lower high pattern at this point, I would say would be taking out this candlestick, and the top of that is 2746.8. So to break the hourly lower high pattern would be taking out the same level as invalidating this bearish engulfing candlestick and getting above the daily T line. So that's a nice level. That's where we can start thinking that, okay, we're not just going to come straight down and break these lows. Something else is going on. But for now, as long as that holds, I'm still remaining bearish. All right, that should be good for now. Serial Trader signing off.